Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting. Hello friends. Let us in this chapter discuss about the most important and one single compulsory element involved in every financial transaction that you undertake in your financial journey. In one word, we can call this as hedging. Hope you have covered previous chapters and keeping continuity. There is a very common hedging instrument known to all of us, but that does not generally get categorized or even understood as hedging. That is insurance. Life insurance is just about creating a protection in monetary terms against your life. Let us not get into an argument of whether insurance actually means hedging or not. Let us just focus on hedging as a financial instrument for this series. As per simple English dictionary, the word hedge means a line of bushes or small plants grown as boundary or border for an agricultural farm or field. This is the actual way hedging works in financial world also. Hedging is an act of creating a structure of protection or a ring of boundary for your financial wealth. In financial activities, when we keep our money, we need to also create a protecting ring to ensure that there is no loss of money. This is simply the same way insurance works in life. Insurance, life related or even other insurance, generally is just to secure an amount of money based on happening or not happening of an event, and this securing is created by paying an amount to the insurance company called as premium. In your financial journey and accumulation journey, when you place your money in any of the instruments, you actually make such decisions after sufficient analysis and research. This analysis actually creates the confidence and conviction in your decision. However, as we have seen earlier, the analysis leads us to decisions in terms of risk, reward and time frames. As we look at risk factor in the analysis process, and when the risk is understood, there are certain actions required to protect against those risks. This activity of protection or creating the protection ring against risk is executed in many ways. That is, there are many options to do this. Let us touch upon a few examples. People, when choosing equity shares, which are expected to be very volatile, correspondingly place some portion of money in gold, which is considered less volatile. By this action, the risk of volatility in equity shares is hedged or protected by negligible volatility in gold. I know a friend who used to take a life insurance corresponding to each loan he took against each machinery he added in his factory expansion. The premium paid is cost incurred for this indirect hedging or protection against the loans he was taking. If something happens to his life, repayment of the loan is secured by the insurance amount and does not fall on anybody else or leading to attachment of machinery or factory. This was his theory. One more example, even within equity shares, if one chooses a interest rate sensitive company like a bank, some proportion of money should be correspondingly placed in non-interest rate sensitive company, maybe like an IT company. These are some examples. This protection can be built even within a transaction. When your analysis recommends buying an instrument with probable growth of X percentage and let us say that growth does not actually happen, you can fix a probable point of exit if the growth does not happen. This exit might result in a loss as against your envisaged profit. Such exit point is referred as stop loss. It is generally advised no transaction should be undertaken in financial market without an expected stop loss. This stop loss can be money based or time based. For example, if you buy an instrument for 100 and expect the same to increase to 110 within 1 year based on your analysis. When you enter the transaction, you should fix a stop loss like say unexpected downward price movement to below 95, or in terms of time you can fix a maximum waiting period of 2 years. Please understand, each of this number in the example is a result of analysis and none of this can be raw guesswork or wishfully thought numbers. In this example, buying price of 100, expected selling price of 110 and time frame of 1 year alone are not found in your analysis. Analysis of overall element and risk element is what shall drive you to fix a price stop loss of 95 and time frame stop loss of 2 years. This stop loss is an integral part of your transaction and hence in principle I treat the same as a hedge. Whether through stop loss or another cross product transaction or through any other mechanism, one should definitely ensure an hedge or cover for risk involved in financial markets. Without this, or going for an uncovered or open transaction is a huge risk and no analysis will support such a transaction. Going forward, we will discuss each instrument along with all the probable analysis elements including return expectation, risk involved, along with hedges to protect those risks, time frame factors, etc. and based on numerous variables involved, how these instruments and analysis elements shall be suitable for different people at different points of time. With that, I will close this. We will see you in the next video. Thank you. Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting.